Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent CPI data that came in earlier and the implications on the terminal rate for the Federal Reserve, amongst other things. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, expectations for core inflation were 5.5%. You can see that it came in at 5.5%, and you can see that it came in at 5.5%. Furthermore, headline inflation expectations were at 6%, and again, you can see that it actually came in at 6%. So, all in all, the expectations or the consensus was met, right? We actually got inflation readings that people more or less expected. Now, what's interesting is if you take a look at this a little bit closer up, so if we take a look at inflation, so this is that headline inflation we were just looking at, you can see that it's continuing to come down. So, it sort of slowed down a little bit here. This is headline inflation, but it actually continued to move down in a relatively reasonable pace. If we look at this on a monthly change, you can see that it was starting to, the rate of decrease was starting to slow down. It was still going down. Now the rate has picked back up again. So headline inflation is still coming down, which is a good thing. I mean, we want to see inflation ultimately come down so we can get to a more or at least better economic times, right? I think is the idea. Now, it's not as rosy for core inflation. So again, remember core inflation, if we pull that up, it came in at 5.5%. And the issue here is that, it's slowed down. It's still going down, but it has slowed down some, right? So it was 6, then 5.7, then 5.6, then 5.5. And it's not really moving down as quickly as we might otherwise want it to. Now, this website is forecasting that it'll come in at 5% in March, which is obviously a lot lower and would be a good thing to get inflation back down to 5%. If you look at core inflation, though, if we go take a look at core inflation, so this is core inflation right here, and you can see that it has come down, but it is sort of leveling off a little bit. And while my general expectation is that it will likely continue to go down, like if we were to look at core inflation, let's say 6 months from now, I would expect for it to be lower than where it is today. But if you look closer at this, you can see that core inflation last time was at 5.55%. 5.55. So here it's just rounded up to 5.6, but it was at 5.55%. And today it came in at 5.53%. So, it rounds to 5.5, but in reality, they were essentially the same thing. If you look at the monthly change on this, again, you can see it's still technically going down, but the pace at which it has gone down has not. I mean, it's not going down as quickly as it was. Is the thing, and ultimately, I do expect core inflation to continue going down if you do see. We talked about this before, right? If we do see it reaccelerate at all, in a more sustained way, anyways, right? Like I think it would be somewhat short-lived. Like you can see these peaks here have been getting sort of lower and lower down, and the sort of the valleys down here are putting in, getting lower each time as well. So I would suspect that if it does push up a little bit higher, and it does reaccelerate, I think it'll be somewhat short-lived, maybe a couple of months, and then start to come back down in the back half of the year. Because I mean, one of the reasons why I think it could come down is if the United States goes into a recession, or if we get close to a recession, right? I mean, but I think there is that risk that we still have to consider if a recession brings about that disinflation that the Federal Reserve is ultimately wanting to achieve. But I suppose we should talk a little bit about how this has affected the terminal rate. And honestly, this hasn't really affected it a whole lot. If you were following what happened over the weekend, you would have noted that the Fed basically backstopped deposits to to these banks, not only the banks that have been failing, but also to other banks that need it, um, which has essentially completely shifted expectations for the terminal rate. Now we've talked a lot about this, and if you go back, if you go back and look at some of my older videos from early 2022 and throughout 2022 and early 2023. I first started off by saying that I think the Fed will make it to between 4 to 5%. This was back when the when the Fed funds rate was like 1 or 2%. I said I think it'll go all the way up to 4 to 5%. But then as we got into some of those 75 basis point rate hikes, I revised it and said I think it'll make it to at least 5%. Now the market still thinks that it'll make it to 5%, but it's not that convinced it's going to go that much higher. In fact, the market right now says two more 25 basis point rate hikes, followed by a rate cut as early as June, which is going very much against what Powell has said, right? Higher for longer. So the things I think to think about here is, what do these investors, what are they seeing that the Fed's not, right? So why does the Fed say higher for longer, but the investors over here don't really believe them? And again, one of the reasons I think is because, well, the Fed sort of broke something with regards to raising interest rates too quickly, and it led to the failure of banks like Silicon Valley Bank, which I'm sure you've read about at this point. So I think normally when something like this happens, the Fed will cut relatively soon, and so I suppose it's we're getting into the time where we're going to see how committed Powell is to actually bringing inflation back down. Will he continue to raise interest rates into an economy that is starting to show cracks? So we talked before about how they can keep raising, but eventually they're going to break something. Now, arguably, they've sort of patched that up. And because they've patched it up, it hasn't led to a run on the banks, right? It hasn't led to necessarily the financial crisis that it could have had they not done that. But another argument is that by doing that, it allows them to continue hiking, because it essentially gives these banks. I mean, to some degree, they sort of bailed them out. I mean, the ability to I mean, if you read what they wrote and valuing some of those assets at par, then to me it sort of sounds like a bailout, right? I mean, they don't want to call it that, and they're certainly not bailing out like investors of the bank, but certainly they've at least put an end to the crisis. And I can't necessarily fault them for doing that. I mean, they're not. It's the Federal Reserve. They're not just going to watch a run on the bank occur towards to all these regional banks, because then you have a problem that might be worse than inflation, right? If people in the world, or if people in the United States can't really trust their money is safe in these regional banks, then that could lead to even bigger problems than the inflation problem. So I do think it makes sense what they did, and but because of that, the market is now expecting rate cuts. Now, here's the thing about rate cuts. Historically, rate cuts occur when the U.S. economy is very weak. So investors are sensing that the economy is going to start getting very weak around June. Okay, so in about 3 months or so, investors are saying, you know what, the Fed's going to have to start cutting because they've damaged the economy too much. The issue with that, though, is we know that markets are not usually going up when the Fed is cutting. And in fact, I mean, if you were to go take a look at the S&P 500, one of the things that we've noted here, I mean, it has been going down essentially since late January, early February. And so, I mean, it's potentially sort of sniffing out some of this weakness. I mean, I'm not saying that it can't rally back up, but when you think about the idea of rate cuts, what it says is that these investors are sensing weakness in the U.S. economy. And they think that because of this, right, that the Fed is going to be forced to pivot and sort of stop its fight against inflation. Now, the Fed could potentially do something like that if inflation were to come down quickly, okay? Which headline inflation, again, arguably is coming down quickly. I mean, it might not be coming down as quickly as they want it to. It's still at 6%, right? Like it's not a great number, but it's at least going in the right direction. But core inflation has sort of stalled out here, and it hasn't made a ton of progress really over the last few months. I mean, we were at 5.7% in December, and now we're at 5.5%. So it hasn't really changed a lot since December. And so this is calling into question, has the Fed done enough to ultimately bring inflation back down? Now, one of the things that we mentioned a lot of times, in fact, is that it often takes about 1 year for interest rate hikes to fully be felt by the overall economy. And it doesn't mean it's not going to be felt more immediately in, say, 30-year fixed mortgage rates, but in terms of propagating throughout the entire economy, a lot of these interest rate hikes take about a year. And it was about a year ago that we had our first 25 basis point rate hike. And now there's some cracks starting to form. And so I suppose the issue is, well, what happens when we get, to this summer and then we're starting to get a year from the 75 basis point rate hikes that really went in. And you could argue that is why the market is starting to sniff out some weakness in the US economy and is sort of calling here for a potential pivot by the Federal Reserve sometime in the middle part of this year. Now, there's no guarantees that the Fed is going to cut as soon as June, and they might be somewhat stubborn and go higher for longer just to make sure they crush inflation. Powell has said many times that the historic record cautions strongly against prematurely loosening policy. And so if he says that, and he said it basically every single meeting for the last year, now we're going to figure out if he actually meant it. Like will the Federal Reserve continue to raise rates even into an economy that is starting to show signs of weakness? Okay. Now, if you go take a look at the yield curve, which I think is worthwhile to go take a look at, you can see that it is still fairly inverted. I mean, the short end of the curve still could go up a bit higher and fully invert, but still an inverted yield curve. And this is, normally precedes a recession. We had it in 2007 as well, before the financial crisis, and also in the dot-com crash that ultimately we had a recession in. And you can see that it's there, right? It doesn't mean that assets can't rally into it until the economy really shows that weakness that markets are starting to sort of sniff out. But this inversion of the yield curve has made some changes recently. If you really zoom in here on this treasury yield spreads, yes, the 3-month and the 10-year has come back down, right? So it's come back in quite a bit to this prior level that it was at in January. But the bigger thing I think to look at is the spread on the 2-year and the 10-year, because it's actually come up quite a bit recently. And so if you think back to some of the things we discussed, when this is inverted, you don't typically have a recession, right? I mean, like, especially like when you look at like the 3-month and the 10-year, when it's inverted, you don't have a recession. It's when it uninverts that you have a recession. And we've seen this play out time and time again. And this is why I have continued to be in the camp that we're not in a recession right now. I mean, you're still looking at real GDP putting in new highs. We still have very low levels in the unemployment rate. And so how can you look at this and call it a recession? Now, I mean, I imagine for, if you're an equity investor and you're over here looking at the S&P below its 200-day SMA and it just looks like a pretty pathetic chart, you might be inclined to think it's a recession. But, the S&P has had bad years before, and it didn't necessarily constitute a recession. Okay. I mean, 2018 was pretty bad, especially at the end of 2018, but it wasn't a recession. And so you can have down years in the market and it not necessarily be a recession. So that's why my thinking on this, once again, is that essentially what you're looking at is, yes, there's signs that the economy is getting weaker, and you can look at the 2-year and the 10-year spread to say market participants are starting to think, hey, the Fed's probably going to pivot soon. but there still is no guarantee that they're going to pivot this quickly, um, especially if Powell means what he said. Okay, so I mean, the next FOMC meeting, I suppose, will hear the direction that they want to go, whether they are going to continue hiking, which I do think is the most likely outcome. I think I'll be clear. I mean, I think a 25 basis point rate hike is what they're likely going to do, right? I don't think they're going to go with 50, but I don't think they're going to go with zero either. I think they'll likely go with 25 because I think they're going to want to make sure that they crush inflation. I don't think Powell's going to want to take the risk of not doing it. In front of Congress, he recently testified that that they would be prepared to go to higher rates. So if he was leaning toward, I mean, that was before that was before the meltdown of Silicon Valley Bank. But if he was leaning towards potentially considering a 50 basis point rate hike, then I imagine that still 25 basis points is in the cards. Even with the meltdown of that. I mean, you could argue that one of the reasons they did that, I mean, of course, the main reason would be to prevent a run on the bank, but it also allows them to continue on in their fight against inflation. And so I think you're likely going to see another 25 basis point rate hike to get us to 5%. And that's sort of where I've said before, right? Like, I think we're going to get to at least 5%. Beyond that, I think it's fair to say I don't know exactly how high they're going to go. I mean, it's certainly possible that they could go to 5.25. In fact, that's the general expectation by the market as of this time, right? As of for the May 3rd meeting, they're thinking that the most likely outcome is another 25 basis point rate hike. But I imagine that, yeah, like you could have one or two more 25 basis point rate hikes, but I mean, it seems like we're getting to the sort of the end, or the late stages of this rate hiking cycle. And then once they get there, the idea is to hold them at those levels, as Powell says, right, for some time. The market just simply doesn't believe that. So the market again is sort of sniffing out this weakness, but again, Powell hasn't really seemed to give any inclination that it's going to deter them from it. I mean, he told us there was going to be pain. So we'll see what Powell says the next meeting. Again, headline inflation still looks relatively good in terms of it's continuing to come down relatively quickly. I mean, maybe not as quickly as people might want, but it is still coming down, right? 6.4. I mean, take a look, right? Like 9.1, 8.5, 8.3, 8.2, 7.7, 7.1, 6.5, 6.4, and 6. It is coming down. If you look at inflation, uh, I believe, yeah. So if we look at the inflation rate month over month, yeah, it's up 0.4%. Last month was 0.5. That's not really that great. Um, and if you look at core inflation, right? So if we go back to core inflation, you can see that it really hasn't been continuing to go down in the same way that they might have otherwise hoped it would have at this time. I mean, it's still at 5.5%. Hasn't really made a lot of ground. I mean, since December, right? It's more or less stayed at the same levels, only slightly going down. And so that's where we currently sit today. And you can see that Treasury yield spreads are still quite inverted. But if we do get a Fed pivot later this year, which I think is probably a likely outcome, like either late this year, early next year, later on this year, early next year. I think that's a likely outcome if it doesn't happen sooner, right? If they don't actually completely destroy the economy between now and then you will likely see the uninversion of the yield curve, right? So we have a lot to look forward to this year, but the business cycle, it takes a long time to play out, right? Like by the time you see it in the unemployment rate and everything, sort of one of the last things to finally move. But by that point, the Fed's already done enough damage to the economy. So that's where we currently stand. Hopefully you guys enjoyed the update. Make sure you subscribe, give the video a thumbs up. Again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. You can lock in the lower rate. Thank you guys. I'll see you next time. Bye.